Good
evening, friends. Sorry for late starting. We are waiting for the participant. Now we don't want to miss anybody, so that's why now we are starting the session. It's my proud privilege to start the series on Ind AS. Very up for the upcoming season in the June month after the lockdown. It's time to gearing up the knowledge in this lockdown period. Now, without wasting much time, let me introduce today's speaker, C.S. Shweta Milani Doshi. She is a Bachelor of Commerce from University of Pune. Chartered Accountancy. She is a rank holder also in Intermediate. She is a completed Diploma in International Financial Reporting Standard, IFRS by ACCA UK. Also, he has completed our ICI course on Forensic Accounting and Fraud Detection. She has done articleship in very reputed firm GD Apte and Company. She's also have a work experience as a senior consultant at Simpo Consulting firm specialist in Ind AS from Ind AS. Also, she is a now partner at Doshi RC and Company, heading the internal audit, valuation and Ind AS division of the firm. He has a vast training experience and vast Ind AS exposure. With this brief introduction, would like to introduce today's speaker. Shweta, please continue all your session for next 2 hours. Thank you all the participants.
Yeah, thank you so much for the introduction. Good evening, everyone. Today, I'm here to give you a light over the Ind AS standards. We'll cover the introduction to Ind AS and its applicability. Then we will cover Ind AS 16, Ind AS 38, and Ind AS 40. These are all asset-related standards. Once we cover all the standards, you will have a grip over what is Ind AS and how it is applicable to all the asset-related standards. And wherever you have any questions, just let me know. At the end of the seminar, we will discuss all of your questions. So, beginning with the applicability of Ind AS. As you all know, on 16 February 2015, the MCA issued a notification wherein Ind AS was applicable in a phased manner. What were the phases for such application? The application or implementation of Ind AS in India was divided into two main phases. Phase 1 was for such kind of companies whose net worth is above 500 crores. These companies would be listed, unlisted, or in the process of listing. But whosoever net worth is above 500 crores was in the phase 1. This phase 1 was for such companies whose first Ind AS financial statements had to be published on 2016-17. So in India, the first Ind AS financial statements were published on 31st March 2017 for the entire financial year 2016-17. Then the second phase, phase 2 was for such kind of companies which are all listed companies were covered under phase 2. Irrespective of your net worth criteria, you have to apply Ind AS if you are a listed company. Or if your net worth is above 250 crores, then you fall under the phase 2. That is, your first Ind AS financial statements are to be published on 2017-18 for the financial year 2017-18. But now you will tell that we have also heard of IFRS. So how is IFRS different from Ind AS? India has adopted IFRS, which is 90% similar to IFRS, with certain changes to the Indian scenario. So these are called as converged IFRS. Ind AS is converged IFRS with certain differences to the Indian scenarios. All IFRS are as it is applicable to India. So Ind AS is nothing but 90 to 95% of IFRS with very minimal differences. Over a period of time, government is also trying to resolve or minimize these differences by amending the standards on period basis. Now, you would say 31st March 17 is also over, 31st March 18 is also over. What ahead? Whenever a company falls subsequently, that is, net worth of the company increases by 250 crores in a subsequent period, then from the immediately next financial year, Ind AS would be applicable for that company. What does that mean? So if a company has its on 31st March 2018 or 31st March 2019, if the net worth of the company is say 270 crores, then immediately the company has to publish Ind AS financial statements on 31st March 2020. So you have to apply Ind AS from the immediately next year basis if your net worth is increasing the specified criteria. Now, are only these companies covered under Ind AS? No. Any companies which are linked in sense subsidiaries, joint ventures, associates, holding company, the entire group is covered under Ind AS. So if one company is getting, if the Ind AS criteria or the net worth criteria is getting met for one company, all the aligned or all the synced companies are also covered under the Ind AS regime. So, and one more option was that was previously said that the companies could also apply Ind AS voluntarily. So even if you're not fitting into the mandatory criteria, that is, even if your Ind AS or your net worth is not getting reached 250 or 500 crores or you're not a listed company, still Ind AS would be applicable to you. You can voluntarily apply Ind AS on a voluntary basis. No need of this mandatory criteria. So this is the third criteria. For all these set of companies, Ind AS is applicable. Now, what is the key pointers or key takeaways from this applicability? Once Ind AS is applicable to a particular company, it is applicable forever. So if you be into the mandatory criteria or you be into the voluntary criteria, once you select application of Ind AS, you cannot go out back to the Indian GAAP. You have to apply Ind AS here and after forever. There is no going back from this application of Ind AS. Then what next? For example, if a company was your subsidiary as on 31st March 2015, then in 31st March 2016, it was not your subsidiary. Then what? Doesn't make a difference. If once the Ind AS was applicable to the subsidiary also have to apply Ind AS for all its subsequent financial statements, irrespective of whether it is a subsidiary in the later phase or not. Doesn't make a difference. Second question, my net worth criteria is 250 crores or 260 crores right now. In the next year, I incur certain losses and again I'm back to the below net worth regime. Again, doesn't make a difference. Once Ind AS is applicable to you, you will have to apply the Ind AS. Third question, I would cover this in the later sessions also, but there is difference between what is a subsidiary under Indian GAAP and what is a subsidiary under Ind AS. So if a particular company doesn't meet or wasn't meeting the definitions of subsidiary under Indian GAAP, but due to the detailed criteria of Ind AS, the company is meeting the criteria of being a subsidiary. So what? The Ind AS is applicable to that subsidiary also. So you have to apply the Ind AS principles to determine whether a company is a holding company or a subsidiary company or an associate company or a joint venture company. If the criteria are getting met, then the Ind AS is applicable to those companies also. So we'll cover that under Ind AS 110, but Ind AS 110 provides more detailed criteria under which a larger bandwidth is provided for determining whether a company is a subsidiary or associate or joint venture or not. So in this manner, Ind AS is applicable to various companies. The applicability of Ind AS through a net worth criteria is simpler. It is easier to determine whether a company is about 250 crores or 500 crores. But we have ourselves seen many companies who have missed on to application of Ind AS because they were not into, so we had one of the associate whose holding company was into Ind AS, but that associate company wasn't aware that holding company is into Ind AS. And that is why they skipped on to application of the Ind AS. So in this linked scenario, where the Ind AS is applicable to holding subsidiaries, associates, and joint ventures, it is very important to identify which all companies are getting covered into the region and which are not getting covered into the region. So for the corporates, the roadmap was 31st March 2016-17 and 2017-18, phase 1 and phase 2. Similarly, for NBFCs, the phase 1 and phase 2 criteria was similar. Just for the phase 1 companies, the first financial year was 2018-19. All the criteria were same, 500 crores net worth and everything was same. And phase 2 was 2019-20. So there was certain time gap between which the NBFCs also came into the region. So as of today, the normal corporates and NBFCs are into the Ind AS region. The Ind AS was also applicable to banks and insurance companies, but it got deferred due to various criteria. Various clarifications were required to make the Ind AS applicable to banks and insurance companies. So as of today, application of Ind AS to banks and insurance companies have been deferred. Okay, so let's move ahead to once it is determined that Ind AS is applicable to particular companies, what next? How to apply Ind AS for such companies? How to converge from your Indian GAAP, that is your previous GAAP, to Ind AS? How will you disclose financial statements? Whether you will apply the Ind AS prospectively, retrospectively? How will you give effects to your financial statements? Which kind of disclosures are required? Whether the comparatives are required to be restated or not? What are these criteria and how you should shift from your Indian GAAP to Ind AS is what we would discuss next. So, for example, if a company is into the Ind AS regime, which was into the phase 1 company, so we'll just discuss that as an example. So your first year of financial statements, that is the first year was 2016-17, was your first year in which Ind AS is applicable. So your first complete set of financial statements under Ind AS have to be published as on 31st March 2017. But what all restatements are required? You will have to give a comparative year, that is 15-16. So the comparative year also have to be under Ind AS, and you also have to give an opening balance sheet as on 1st April 2015. So as on 31st March 2017, there would be 3 set of balance sheet, or there would be 3 columns in your balance sheet: 31st March 17, 31st March 16, and 1st April 15. Why 1st April 15? Because balance sheet is as on date. To give the impacts of the Ind AS, to give the impacts from transition to Indian GAAP to Ind AS, one particular date or one particular point in time is required. So as on 1st April 15, that is your transition date to Ind AS, you will have to give all the impacts to your balance sheet. Once you have given all the impacts to your balance sheet, your entire 15-16 comes under Ind AS. Your entire 16-17, which is your live year under Ind AS, comes into the Ind AS fundamentals. So now you have 3 columns into a balance sheet and 2 columns for your P&L. So your P&L would be 16-17 with comparative of 15-16 with opening balance sheet date of 1st April 2015. Now for listed companies. For listed companies, their first Ind AS which came into the public forum was as on 30th June 2016. That was the first quarterly financial statements which came under the Ind AS. So over there, they had to give the first quarter and all the interim quarters under the Ind AS scenario, and then at the end, they had to give the entire complete financial statements under Ind AS. So this is how the entire convergence from Indian GAAP to Ind AS has to be made by giving the date of publishing, or what all kind of columns or what all kind of financial statements have to be published under Ind AS. We will move to the next slide. Now, as we know, under Indian GAAP, there are 2 to 3 set of components of your financial statements. Under Indian GAAP, you had balance sheet, you had statement of profit and loss, statement of cash flows, and notes to your financial statements. These were the only 4 components of your financial statements. Whereas under Ind AS, you have these all components. First is the balance sheet. Second is statement of profit and loss and other comprehensive income. So what is other comprehensive income? That also we'll discuss. Statement of changes in equity, which is also a new statement under Ind AS. Notes to the financial statements, equity and profit reconciliation for first-time adopters. So these are the 3 things which are new under the Ind AS regime. So we'll discuss this one by one. Balance sheet is same as we have it under any GAAP. Statement of profit and loss is same. Other comprehensive income. Now there are various components for which your routine profit and loss or your normal profit and loss should not get impacted. These kind of items have been listed under the Ind AS. Only such selective items have to be published or have to be disclosed under other comprehensive income. Other comprehensive income is nothing but just a statement. So they are provided certain line items. I'll give you an example. For example, I am a company. I have invested into various companies. I have my investments. But my purpose of those investments is not to trade on day-to-day basis. So the basic fundamental under Ind AS is every investment have to be fair valued. Now, if every investment have to be fair valued, why should this fair valuation gain or loss should impact my P&L? Is my purpose trading into these investments? Is my purpose to gain routine or daily profits into these investments? No, I've invested in these investments for a long-term basis. I'm not holding these investments for trading. So such kind of investments or gain or loss on such kind of investments are to be routed through other comprehensive income. So when you pass the accounting entry for such kind of investments, you record the gain under the investments. So investment account debit, you directly credit a reserve, that is gain on the fair valuation of investments. For example, there is a gain of 100 crores. So while passing the accounting entry, you have passed the accounting entry as investment account to fair valuation gain on the investments. But this 100 crores have to be routed or have to be published in the account other comprehensive income, have to be disclosed in other comprehensive income. So other comprehensive income is not an account, it is just a statement to disclose certain items which are provided under Ind AS, which are of specialized nature and which should not affect your routine profit and loss. So we will discuss what items are covered under other comprehensive income in detailed manner, but just to give you a concept of what is other comprehensive income. It is just a statement to give you the details of certain specified transactions. Then next, moving on to the next statement. What is statement of changes in equity? As the name suggests, statement of changes in equity is nothing but a statement which shows your movement between the equity. It includes equity share capital as well as reserves and surplus. So equity share capital, as you give it into your notes to the financial statements, you show the movement in the equity, opening equity, add additions, less any kind of buyback or any kind of deletions, and a closing balance. So this is your movement in the equity or equity share capital, preference share capital, any kind of capital. Second is your reserves and surplus. Any kind of reserves, you show movement of those reserves in this statement of changes in equity. You show all the movement, whatever has happened into this reserves into this statement of changes in equity. Anything which forms a part of equity, for example, minority interest, or also called as non-controlling interest under Ind AS, is also disclosed under the statement of changes in equity, and movement in this non-controlling interest is also disclosed in the statement of changes in equity. Or you have share application money pending allotment, which also forms a part of equity. The movement of this share application money pending allotment is also disclosed in this statement of changes in equity. Then next, cash flow statement is same into what we discussed under the previous gap. It is similar, no changes. Whatever are the changes between the gap that we will discuss in the respective standard. Then next, notes to the financial statements. So for the purpose of notes to the financial statements, you will have to see what each standard provides for the purpose of disclosure and what the Schedule 3 provides. Now Schedule 3 for the Ind AS companies and for the Indian GAAP companies is different. So division 2 to the schedule 3 is for the Ind AS companies and division 3 is for the NBFC companies. So division 2 is for the corporates or non-NBFC companies and division 3 is for the NBFC companies. So whatever disclosure requirements are there either under the schedule 3 or under the respective standards have to be disclosed in the notes to the financial statements. I'm discussing this so that you know what are the sources of information, where to look into. So I'm just telling you what are the sources. There is also a guidance note on the division 2 under Ind AS. So that would also give you a clarification on what or how which kind of disclosures are required under Ind AS. Okay, so moving on to the next slide, what we would discuss is what and how to account the impact as a result of the Ind AS adjustments. Now, as you all know, the accounting policies or the way of recording particular transactions is different under Indian GAAP and under Ind AS. So when there is a difference between Indian GAAP and under Ind AS, obviously there will be certain transactions or events which have arose before the date of transaction. So by default or by a general rule, remember one thing, any particular change in the accounting standard or the GAAP as a whole has to be applied retrospectively. If it has to be applied retrospectively, then you will have to recognize all the assets and liabilities which were required under Ind AS. So if a particular asset was not required under Indian GAAP but required under Ind AS, you will obviously have to recognize it. You will have to de-recognize such assets and liabilities which are not required under Ind AS. You will have to regroup if particular item or if particular event or transaction has to be disclosed in a particular manner under Ind AS. You will have to regroup such items and you have to remeasure also. So there are four main changes: recognize, de-recognize, regroup, and remeasure is what all changes you require to move from Indian GAAP to Ind AS. If you list down all these changes required for your particular company, it is very easy for you to converge from Indian GAAP to Ind AS. It is not a big thing. It will be very simple for you if you categorize all your differences in this form. Now, if you identify such differences, what will you do of the resulting adjustments? अगर एक item was measured at 100 crores in particular in Indian GAAP, now you measure it at 120 crores under Ind AS. What to do of this 20 crores? This 20 crores has to be adjusted in your opening balance sheet. We discussed previously the opening balance sheet. So as per our previous example, these adjustments have to be recognized as on 1st April 2015. So, continuing with my previous example, for example, investments were not required to be fair valued under Indian GAAP, but under Ind AS, you will have to fair value those investments. Though the gain of 20 crores, what will you do of the same? So you will debit the investments account by 20 crores and you will transfer that gain to your retained earnings as on the date of transition. That is, for example, 1st April 2015, and your balance sheet as on 2015 will appear inflated into investments by 20 crores and retained earnings by 20 crores. So whichever items as per the respective recognition criteria, whichever items have to be transferred under retained earnings, you transfer under retained earnings. Or if there is any other appropriate reserve, for example, ESOP reserve, fair value of equity investments, what we discussed previously, such reserve, any other appropriate reserve as per the respective accounting standards. You don't have discretion. You have to refer the appropriate standard to determine which appropriate portion of equity has to be debited or credited for recording these Ind AS adjustments. Okay. Now, this is for all the items which have to be recognized mandatorily under Ind AS. So, as I said, as a general rule, retrospectively, all adjustments, whatever is the difference between the Ind AS and the Indian GAAP, has to be mandatorily recognized. But there are certain exemptions and exceptions. What do you mean by this? Ind AS 101, transition to first time adoption of Ind AS, this standard has provided certain exception to this general rule. So our general rule is mandatory retrospective adoption. So an exception to this general rule are mandatory exceptions as per Ind AS 101. What do you mean by this? Mandatorily, you don't have to record for these exceptions. So even if there is a difference, the accounting standard also knows that there is a difference between Indian GAAP and Ind AS. But the Ind AS 101 has mandatorily provided that you don't have to record for this differences. This is mandatory in nature and you don't have any option. And second, and these are a set of list. So you will be provided with a list which have mandatory exceptions, that mandatorily this is not allowed. And second is the optional exemption. What do you mean by optional exemptions? You have an option whether you want to go with this exemption or not. So, for example, if there is a difference between two particular standards, so on your own you can account for that difference. But if you want, there is an option of not accounting for such difference and continuing as it is as per your previous amounts or previous GAAP amounts. So this is optional in nature and this is mandatory in nature. So you will have to refer Ind AS 101. We will also cover standard by standard basis what are the mandatory exceptions and what are the optional exemptions. But I'm just giving you a source which provides the mandatory and optional exemptions. If you have any queries till now, you can note it down and we will discuss it at the end of the lecture also. Now, this was all about the Ind AS, how it is applicable, to whom it is applicable, and how to give impacts of Ind AS. So this is just to give you a broader picture about how you need to transit from your Indian GAAP to the Ind AS accounting standards. Now, there are list of standards which are covered under the Ind AS. There are certain standards which were previously not at all there in your previous Indian GAAP, but there is a complete set of standard under Ind AS. One of which we are going to discuss today is Ind AS 40, investment property. There was no detailed standard under Indian GAAP for this particular transactions, but there is a standard over here. Various such transactions are non-current assets held for sale and discontinued operations. Ind AS 105, which is also a standard which was not there under Indian GAAP. Then there is a detailed guidance on financial instruments, which is one of the critical and the most important standard under Ind AS, and which has majority of concepts, a bit difficult concepts also I would say, but very important if you need to understand Ind AS financial statements. Then you have deferred tax, which you also, I mean, we had deferred tax also, but we have a detailed guidance under Ind AS on deferred taxes. You have revenue recognition, Ind AS 115, which has been recently amended from Ind AS 11 and 17. So revenue also, if you look into the Ind AS, the principles are same, but the detailed guidance or the variety of transactions which are covered under Ind AS for which the guidance is provided is, you don't, I mean, the Ind AS does not leave you with choices. People cannot follow different accounting policies because there is lack of guidance. Then one of the important standard also is the consolidation and the business combinations. So these are the four critical standards under Ind AS, and other are there with certain differences. So today we will cover Ind AS 16, that is property, plant and equipment, Ind AS 38, that is intangible assets, and Ind AS 40, that is investment properties. By this, we will be able to cover the major asset related standards. So we'll go one by one. If you might be aware, for the government had amended AS 10 on 30th March 2016 by bringing in a notification, which was applicable from 2016-17. When the government brought in this notification, AS 10 was made majoritarily in line with Ind AS 16. So previous AS 10 vis-a-vis Ind AS 16 had more differences, but the amended AS 10, which was applicable from 16-17, had lesser differences as compared to Ind AS 16. So today I will tell you what is the difference between Ind AS 16 compared with the amended AS 10 compared with the old AS 10, because not everybody is updated with the amendments to the AS 10. So we will cover all the differences. Then we have Ind AS 38, which is the intangible assets, which has to be compared with AS 26, intangible assets. And we have Ind AS 40, investment properties, for which there was no comparable standard under Ind AS. There was a minimal guidance under AS 13, investments, but very rare of the companies used to really get the gist of those standards, and there was no detailed guidance under AS 13 also. So these are criteria we'll cover. One more important reason to cover all these three standards together is all the recognition criteria, the main definition of the asset, the measurement criteria are 99% similar for all the three standards. So even when you will study or when you will read it for your application to your real companies, read all these three standards in conjunction with each other, because I mean the basics of the standards are similar. You will have to just classify whether it is a property, plant and equipment, or whether it is an intangible asset, or whether it is an investment property, and apply the respective criteria. So recognition, definition and measurement are similar for all these standards. Now, going ahead with the key definitions for recognition of an asset. As we have studied from our childhood of the accounting, an asset has to be recognized only if the asset is controlled by the entity is expecting certain future economic benefits out of that asset, and the asset is expected to be used for more than 1 year. So only if these three criteria are satisfied, then only you recognize any particular item as asset. So for deciding the criteria, I mean how you should look into a particular transaction is first of all whether it is an asset. If it is an asset, only then you move into the further criteria of which category of asset it is, whether it is PP, whether it is intangible asset, whether it is investment property, whether it is certain other financial instrument, but it should be first of all an asset for the company. Now, what do you mean by controlled by the entity? Tell me for an example, today I'm a pharma company. I have lots of researchers into my pharma business. These are the employees for my organization. And every time I tell my employees that employees are the assets for the company. On the every appraisal cycle also I tell them that employees are the assets for the company. Does that mean I recognize employees into my balance sheet as an asset? And if no, then why don't I recognize such employees into the balance sheet of the company? The important reason is even if I might be expecting future economic benefits out of my employees, even if they are expected to be stay more than 1 year, but I don't have control over those employees. I cannot tell an employee or I cannot mandate an employee to stay into my organization for a long period. So that is why such kind of employees are not recognized as assets into the company. This was a very simpler example. But for example, a cricket club has a contract with the individual players to stay with that club for a particular tenure. It might be 2 years, 5 years, whatever is the tenure. So that club has to receive the services from that player for a particular period. In such cases, what to do? Now, since you have a contract with such particular employee and the employee cannot move out of your club for that particular period, then you can recognize the amount paid to get the contract with that employee. There are there's certain amount paid to get the rights. So that amount can be recognized as an asset because you have control over it. So this is another example of the cases where such contracts are recognized as an asset. Another example, we ourselves have converted so many companies where you won't imagine certain transactions which out of nowhere came into the difference regime or out of nowhere came into the Ind AS regime. One more example. Suppose I'm a construction company. What did I do? I'm a construction company. I constructed a particular asset for the particular employees. I constructed a club. As a consideration for my club, the government did not pay me anything. Instead of that, the government gave me rights to collect the membership fees from the members entering the club. Now tell me, I did not get anything immediately, but I got rights on which only I have control over that rights. The government cannot later on say that, okay, no, from today I will collect the membership. So that is why I have control over my right to receive the membership fees. Even in that case, that right is also an asset and which has to be recognized as an asset into the books of the company. Another example is, there are varied examples. So we'll cover that in detail manner later on also, but these are the cases where specifically there are many companies which enter into such barter transactions and you will have to keenly look into such barter transactions to understand whether these are satisfying the criteria of an asset or not. Now, these assets can be held for production, can be held for rental, or can be held for administrative purposes. It is not like my building or my administrative building is not giving me direct future economic benefits, but it is my linked asset to my main activity of the business. That is why it could be any of these criteria, or it could be an asset without a physical substance. So these criteria of assets are the property, plant and equipment, and this criteria of assets are the intangible assets. So assets which are identifiable assets but lack physical substance, those are the intangible assets. For example, a software is a very simple example and which every company has. So these are your intangible assets. We'll cover more difficult examples also. So these are your intangible assets. Now main change or main clarification is, previously various times the pre-operative expenses or the startup cost are capitalized into the books of the companies as pre-operative expenses, miscellaneous expenses into the as an asset of the company. But even under AS 26, these were not allowed to be capitalized as an asset in the books of the company. And under Ind AS, these are specifically excluded from the capitalization. So this is not a gap difference, but these has to be looked in because even in the current practices, these are capitalized as an assets under the books of the companies. So as we discussed, this is the property, plant and equipment, and this is the intangible assets. So only thing which lacks physical substance we'll have to see as a intangible assets. But what do you mean by identifiable? Now, what identifiable is, which arises out of a contractual or legal right and is separable from the company. So only if an asset arises from a contractual or legal right and it is separable, then only you can say that a particular asset is an identifiable asset. Now, for example, as a customer or as a company, I have a brand name, or me as I am a Kaka Halwai, I have a huge brand name. Does that mean I can recognize my own brand name into my own financial statements? Obviously, no. The main reason is, can you separate that brand name from to your own business? You cannot separate your own brand name. Otherwise, there is no business. If Kaka Halwai is not working under Kaka Halwai, it doesn't have business what it existingly has. Unless it is a purchased goodwill, you cannot recognize the goodwill into your financial statements. Second example, you have a customer list. By conducting the business itself over a tenure basis or over a day-to-day basis, you developed a huge customer records. We have great examples like Facebook. We have great examples which apps work for the purpose of generating the customer list. Now, whether these are intangible assets or not, these are intangible assets because you can separate that out of your business. You can sell the customer price list to another company for their own benefits. So many transactions occur where the app or any business sell their customer list to Facebook or such any other entities. That is why customer list is an asset to the company. Then what is the second criteria? The second criteria is how will you identify whether, how will you define whether a particular asset is controlled by the entity or not? If a asset is controlled by the entity, that particular entity should have the right to get the future economic benefits. And that entity should restrict others to get the benefits out of that assets. We have a classic examples of, for example, a road. If a particular entity builds a road specifically to lead that road to its factory, now, even if the entity is getting benefits out of that constructed road, can a particular entity deny access to other people from using that asset, from using that road? Obviously, no. Since the particular entity cannot deny access to general public from accessing that road, the company or the asset is not controlled by the entity and the asset cannot be capitalized into the books of that entity. So it is very important to define key. It is very easy to identify whether the particular entity is getting the future economic benefits, but it is very difficult to identify whether the entity can restrict the access to another people or not. If the entity can, only then it is controlling that asset. So this criteria is very important and many people miss on to recognizing or giving impact of this criteria itself. So restricting access to get the benefit out of that particular asset. So only if these criteria is fulfilled, then only you can, or then only a particular item can be recognized as an asset into the books of the financial statements. One more example we will study is a particular entity is into the global positioning business. For the purpose of understanding that GPS or for the purpose of conducting that GPS, the entity developed maps for its own understanding. And those were such maps that, or those were used through such technology that nobody else could use or access that maps. So since nobody could use or access that maps and it was developed for its own understanding, it is very difficult to identify whether this asset is separable or not. It is a questionable case. So only if this asset is separable and anybody else can use that asset easily and it is not specific to that particular entity, only then you will recognize that cost also into your books of accounts. If you have any queries, please note it down and we will discuss it ahead. So this was about, these criteria were about what is a property, plant and equipment and what is a intangible asset. Please note this word rental. We will discuss it ahead also. So please remember this, we will discuss it. Now, you are understanding investment property. There is a specific standard for investment property, but you all would be having a question in mind, what exactly is investment property or what all items have to be classified as an investment property? So Ind AS 40 has given a particular criteria or has given a set of guidelines. Only if a particular asset is fitting into those guidelines, it will be classified as an investment property. So the first criteria is the property has to be land or building. No other item can be classified as an investment property. It has to be a land or building. Second is it has to be held for rentals. That is, you should have given a property for rentals or you should have held that property for the purpose of capital appreciation. And it should not be used for the purpose of production of goods or giving the services to the services or for any other administration purposes. And it should not also be held for the purpose of sale in the ordinary course of business. So ignore the not for the time being. Just let's discuss what has to be included. So it has to be a land or building. And second is it has to be held for rental. So if you want to see if your company is giving any properties on rental, it might be smallest as flats or something. The company has invested into flats and for a time being they have given it for rentals. So that is one which has to be classified as an investment property. And there is no materiality criteria. You cannot say that it is just a 1 crore flat and my company is 1,000 crores. You have to classify that as an investment property. And second is held for capital appreciation. You're not using it into your business. You're not intending also to use it into your business. You've just held that property for the purpose of capital appreciation and later on you're going to sell it and receive certain benefits out of it. So that also has to be classified as an investment property. Now, how will you decide what is the intent of the organization? At the time of purchase of such huge properties, they obviously have certain board resolutions. For what purpose is this property held? By having certain documentary proof only you can decide whether for what purpose is the property held. Now, one more classic criteria is if there is an unintended use. That is, as of now, the company is like, I might use it, I might sell it, I don't know what might I do out of it. So if there is an unintended use of that property, it has to be mandatorily classified as an investment property. So if your company is giving you reasoning that abhi pata nahi hai kya karenge, it might be into whatever criteria. So again, it is an unintended use of the property and you will have to classify it as an investment property. So this is very important: rentals, capital appreciation, or an unintended use. So if a particular asset is, if it is has to be for an unintended use, then you classify it as an investment property. Now, since these criteria are for the, the positive criteria, obviously the negative criteria are it should not be used in the production or service of the goods or providing the services, and it should not be held for sale in the ordinary course of business. For example, I'm DLF. I am holding flats for the purpose of sale. It is my inventory, and I cannot recognize that flats as an investment property. And this is a mandatory criteria. You don't have any option whether a particular item has to be disclosed or has not to be disclosed as an investment property. So moving ahead, there are certain examples which we'll discuss, which you first think whether these are investment properties or not, and I will give you the subsequent answers. Land held for long-term capital appreciation. As we discussed, it is an investment property. Building occupied for administrative purpose, whether it is an investment property or not. Since it is administrative purpose and you're not using into the business, what will you do? It is a property, plant and equipment. Administrative purpose is an aligned activity. So that also has to be your main property, plant and equipment. Building held for finance lease and leased out under operating lease. What should you do? Investment property or property, plant and equipment? It is held under finance lease and it is leased out under operating lease. So you're recognizing that asset into your company since it is a finance lease and you're leasing it out. It is a very simple question just framed in a difficult manner. You are holding an asset for the purpose of giving it on rentals. So that is an investment property. So don't get confused by a finance lease and operating lease. Then tower cranes held for the purpose of rental purposes of a construction company. There are various construction companies who do not own their own plant and machinery. They get it on rentals. So if a particular company is giving such tower cranes on rentals, what to do? It is held for the purpose of giving on rental. Investment property or property, plant and equipment? It is a tower crane. That is, it is a plant and machinery. It is not a land and building. So by default, any plant and machinery doesn't fit into this criteria and will never become an investment property. So that is why this was, I had asked you to hold on to this rental purposes. So PP IAS 16 or Ind AS 16 covers only those assets which are not land and building and given for rental. So if I give my vehicles on rent, if I give my plant and machinery on rent, if I give my any of the furniture items on rent, even if they're given on rent, it has to be classified under Ind AS 16, property, plant and equipment, and will never fall under Ind AS 40, that is investment property. Then land held for undetermined future use. You don't know as of now what is the future use of that land. So as we discussed, unintended use or undetermined use has to be mandatorily classified as investment property. Property under construction to be leased out under operating lease. Now, even if it is under construction, still this property has to be classified as investment property. So don't wait until it will finally get constructed and then you will classify it as investment property. Still, it will be as an investment property itself. Building occupied by employees. This is a tricky case. Building occupied by employees, whether it will be investment property or a property, plant and equipment. It will be property, plant and equipment itself because it is for the main, the company can give its building for the employees. So it is for its main purposes itself and it has to be classified as an investment property. Property constructed for sale in the ordinary course of business. As I gave the example of DLF, it is an inventory and has to be classified as per Ind AS 2, that is inventory standard. So these are the criteria to define whether a particular asset is an investment property or not. Moving ahead. To the next slide. So what if a property is of a dual purpose? I have 4 floors in my property. 2 floors I'm using it for my own purposes and 2 floors I have rented out. In that case, what to do? You will have to decide whether it is capable of being separated or not. Can you give that entire property or can you sell that 2 floors of your building independent of your own 2 floors? If it is yes, if the criteria is yes, if it is capable of being separated, then you will separate the amounts. You will whatever is apportioned to property, plant and equipment, what you are using for your own administrative purposes will be property, plant and equipment, and whatever is given on rentals, that is the investment property. But what if it is not capable of being separated? A classic example, I am Imagica. I have given my certain portions to certain restaurants. I have given this 500 square feet to McDonald's. Should I classify that 500 square feet as an investment property? Can I sell only that 500 square feet to another entity? Obviously, no, it won't be feasible for my kind of business. Since it is not feasible, the division is not capable of being separated. Then what to do? In that case, you will decide what is the significant portion. If your significant portion is investment, or what is insignificant portion? If your insignificant portion is investment property, then you classify the entire asset as a property, plant and equipment. If your insignificant portion is investment property, plant and equipment, then you'll classify the entire property as an investment property. So here you will see the insignificant rule. Whatever is insignificant, ignore it and classify the entire asset as a PPE or as a investment property. So this has to be done for a dual purpose property. So till here we understood what has to be a property, plant and equipment, what has to be an intangible asset, and what has to be an investment property. So this was just a classification criteria which asset falls into the which criteria. Then we have the measurement criteria. Measurement criteria is similar for all the 3 assets up to 99%, I would say. Few minimal differences are there. So the measurement criteria is there to define how to measure that particular asset. Now, what it is very simple. This was there under your previous standard also. We'll just clarify, and there are few differentiating points over here. As we know, any particular asset has to be measured under cost. Many people had a disbelief or had a myth that under Ind AS or under IFRS, everything is at fair value. So it is not that way. There are certain standards which require fair valuation, but not for such kind of assets. Even property, plant and equipment, even intangibles has to be recognized as cost plus directly attributable expenses. So what does directly attributable expenses mean? Expenses which were incurred to bring an asset to a location and condition which is necessary for its intended use. So whatever expenses were incurred to bring that asset, to bring into that condition for which the asset was designed to be used, all such expenses have to be capitalized. So these includes all simpler examples such as your the transportation cost, your loading unloading cost, then your duties if those are not refundable. These are simpler examples. But I'll give you another example. What if you'll have to remove a previous asset? I have an existing factory. Already there is a plant and machinery on that location. I have to dismantle that plant and machinery and set up my plant and machinery. In that case, what will you do of that dismantling cost? Is it linked to your new asset? Some would say no, it is not linked to my new asset. And that cost is not giving me any benefit. That is just a discarding cost or a cost incurred for the disposal. Other way of argument can be, unless I remove that particular plant and machinery, I cannot set up this new plant and machinery on that location. So what to do? In Ind AS 16 also has a clear criteria on this. Even such dismantling cost or such relocation cost also has to be capitalized into the cost of the property, plant and equipment. Then there is another important criteria, another important cost, which is a dismantling and restoration cost. We'll discuss that in a detailed manner. For example, today I'm a windmill power generation company. I have set up multiple windmills into the various locations. Now wherever the windmills or wherever I've set up these windmills, I have a clause in my agreement that whenever the lease term will end, 30 years, 20 years, 25 years, you don't buy that area, obviously. I mean, if you have your own land, that's a different question. But if you have rented or leased out that particular land from certain governmental authority, you have a clause in that agreement that at the end of the lease period, at the end of the term, you will have to dismantle and restore that land as it is. So you might have dig certain portion of the land, you might have installed certain equipments under the land. You have to restore that land as it is and bring it into the location how it was given to you. Now, this cost has to be incurred after 25 years, agreed. But on what account are you incurring this cost? Because you have installed that windmills into that particular land, that is why you are incurring this cost. So since this asset or since this cost is directly linked to your asset, it is a directly attributable cost. And even if it has to be incurred after 25 years, still this cost has to be capitalized into the property, plant and equipment. Now you would say at what amount? For example, after 25 years, I would incur certain 25 crores of cost that I'll incur after 25 years. Now here comes a provision which is linked with another standard, that is Ind AS 37. So Ind AS 37, that is provisions, contingent liabilities and contingent assets, provide the measurement criteria for such kind of costs. These costs has to be discounted to present value. So 25 crores I'm going to incur after 5 years or 25 years, I'm sorry. So since I'm incurring that cost after 25 years, I have to discount it to the present value. And the present value of that amount, for example, it is say 15 crores. That 15 crores has to be added to the property, plant and equipment. So if my original cost is 100 crores, plus that 15 crores, 115 crores has to be the cost of property, plant and equipment. And this cost has to be depreciated over the over your tenure, over the useful life of the asset. Now another question is, at what rate should I discount? Should I take my own weighted average cost of capital? Should I take my cost of borrowing if I have taken certain loan for purchasing that asset? At what rate should I discount? These are the practical issues which arises. So by provision, you might know that decommissioning cost has to be capitalized in the cost of property, plant and equipment. But at what rate? Ind AS 37 provides that such provisions has to be discounted at the risk-free rate of return. So you will use the risk-free rate of return for the designed tenure for 25 years and you will discount it using that rate of return and add it to the cost of the property, plant and equipment. So this is another difference between the old AS10. So old AS10 did not have any specific criteria for decommissioning and restoration cost. There were certain guidance notes, for example, guidance note on accounting for oil and natural gas companies. Such guidance note provided criteria or provided the policies or the guidance for capitalizing such costs, but it was never given into the standard. So only such designed companies, oil and natural gas companies, used to follow such accounting policies. Under the revised AS10 and under the Ind AS 16, such decommissioning and restoration cost has to be capitalized into the cost of the asset and depreciated over the useful life. Under Ind AS 37, you would study that how that provision would come into the, now today we had the 25 crores of provision, which will incur after 25 years. You have discounted it and brought it to 15 crores. That 15 crores was added to the property, plant and equipment. Now, how will this 15 crores amount reach to 25 crores at the end of 25 years? What will you do over the period? If you don't do any accounting, at the end of 25 years, you will realize that in your books, the provision is still appearing at 15 crores, but you will have to incur 25 crores. Then what to do? Will you debit 10 crores to that year of that financial year? What will you do? So you will have to think from every perspective. This decommissioning is not just a single accounting entry. This 15 crores has to be bought to 25 crores by debiting your P&L by the finance cost. So every year you will debit 7% of 15 crores to your profit and loss account, and at the end of 25 years, this amount would reach from 15 crores to 25 crores. So this is the entire accounting for the decommissioning and the restoration liability. Your account heads what are impacted are the property, plant and equipment, decommissioning and restoration cost, provision for decommissioning and restoration cost, finance cost, which is debited to your P&L over the period of 25 years. Now, what should not form the part of, what should not be cost of your property, plant and equipment? Your training cost, your feasibility study. You have just not decided which land to invest into. You are just conducting a feasibility study. So as of that date, you don't know whether you will receive a future economic benefit or not. That is why such cost or admin and overheads cost, this is a bigger, you might call it as a difference. So under previous standard or under the previous gap, many people used to capitalize the admin and overhead cost by allocation. So they used to allocate certain percentage of their admin cost and capitalize into the cost of PP. This is clearly not allowed to be capitalized under the cost of your property, plant and equipment. So clear, did we understand what has to be capitalized and what has not to be capitalized? Then is your subsequent expenditure. So subsequent expenditure has to be capitalized only if it meets the asset criteria. If it does not meet the asset criteria, it has to be transferred to the repairs and maintenance account, and it will not be capitalized into your original assets. We will also link it to the component accounting. We'll also link this subsequent expenditure to component accounting. We'll move on to the next slide. Now, any particular asset, what has to be the mode of measurement depends upon what is the mode of acquisition of that asset. So don't look into the pure normal transaction of your buying an asset. Look, give a wider view to it. There are various modes of acquiring a particular asset. For example, if it is a normal acquisition, then purchase plus directly attributable cost. What if you're receiving an asset out of business combination? What to do in that cases? We will discuss this in detail in Ind AS 103, but still to get a holistic view. In that case, such assets are recognized at fair value as on the date of acquisition. Internally generated assets, which are allowed to be capitalized. Directly attributable cost are you recognize that asset using the directly attributable cost. Then the exchange of assets. If there is an exchange of assets, in case of exchange of assets, the asset has to be recognized at the fair value of the asset acquired or given up, whichever is clearly identifiable. So the earlier example I gave, the company had constructed a building and in return got the membership right to collect the membership fees. In that case, you cannot recognize the intangible asset at only the cost incurred by the company. Today I have incurred cost of 20 crores to construct that particular building, but I cannot recognize that particular asset at 20 crores only. You will have to recognize the asset at the fair value. of the asset given up or asset received, whichever is clearly identifiable. What does it mean? If you would have sold that particular building, I'm already a construction company. I already construct buildings for various companies. So if I would have constructed and sold that particular building, I would have added a margin of 10%. So in that case also, you will capitalize the asset at cost plus 10% margin and recognize the value of the asset. So this applies to the property, plant and equipment as well as the intangible asset in case of exchange of assets. It has to be recognized at fair value. What if you have received the asset through a government grant? It has to be recognized at cost or fair value. Fair value has been removed through an amendment to the government grant standard. Previously, it was cost or fair value at the option of the company. With the recent amendment to bring in line the standard with the IAS standard, the IFRS standards, the fair value option is also removed by the government. So these are the various modes of acquisitions and how to account for such assets into your books of accounts. So this was detailed guidance about the measurement of an asset, the decommissioning cost for an asset as we discussed in a detailed manner, and the exchange of assets. So exchange of assets and the decommissioning cost we have discussed in a detailed manner. If you have any queries on the measurement part also, you can list it down. We will discuss it at the end of the session. Moving ahead. Subsequent cost. How to account the subsequent cost? If it is meeting the criteria of an asset, as we discussed through the definition, if it is having a future economic benefit, you have the control and it is to be used for more than 1 year, then you capitalize as an expense, otherwise charge it to the P&L. But here comes the concept of component accounting also. For example, I have a plant and machinery, and my the main part of my machinery, that is a main tool to my machinery, has been capitalized as a separate component. In that case, for example, if my total cost of my machinery is 10 crores and I have capitalized a cost of 3 crores, which is an important part of the machinery, as a separate component. So this 3 crores is my separate part capitalized. Whenever I'll replace that component with a new component, I will de-recognize that original asset and then I will capitalize a new asset. The life, for example, the life of that 3 crores component was say 5 years, but I had to replace that part within 4 years itself. So whatever is the WTV of that component has to be de-recognized. Only then you can capitalize that new component. So just, I mean, on a day-to-day basis, or majority of companies make this mistake. They do not de-recognize that original component and just keep on capitalizing the new components. So you will have to identify whether you have followed a component accounting, or component accounting is mandatory obviously, but whether it is a separate component, whether you should de-recognize that particular asset and then capitalize the new asset. We'll discuss certain examples. So we'll discuss certain examples. For example, for my industry or for my type of asset, the inspection and overhauling cost is a mandatory cost. I'm into the shipping industry. I'm into the airlines industry. After every 3 years, my assets has to be inspected by a particular authority. If they find it that that asset is in a feasible condition to be run, only then I can run that particular asset after the designated period. So whatever cost I'm incurring for the purpose of inspection and overhauling is a separate component and has to be capitalized separately. So if I incur 1 crore of cost after every 3 years, I will capitalize that 1 crore cost as a separate component and I'll amortize or I'll depreciate that cost over a period of 3 years. My original asset might be a 30 crore asset, which might have a life of 30 years. So that will be amortized over a period of 30 years, and my individual component of the inspection and overhauling cost will be capitalized as a separate component and amortized over a period of 3 years. Similarly applies to the spare parts. Again, in spare parts, you will have to define whether that asset is meeting the criteria of an asset and then only capitalize as a separate asset and amortize it according to the life of that particular spare part. Moving ahead to the subsequent measurement of that particular assets. So as under Indian GAAP, similar over here, you have two models. You have the cost model and you have the revaluation model. You can define under the property, plant and equipment for the entire class of asset whether you will have to follow the revaluation model or the cost model. You cannot say that out of my 10 lands, I will use revaluation model only for 3 lands and remaining 7 I won't use. So it has to be for an entire class of assets. If you decide for land, it has to be for all the lands. But that does not also mean that if you are saying that you are applying revaluation model, it has to be for all the property, plant and equipments. You can use land under revaluation model, plant and machinery under cost model, building under revaluation model, your furniture and equipments under the cost model. That is allowed. It is as per the class of the asset. Please remember that. So you can decide which model of the subsequent measurement you are following for that particular asset. If you're following the cost model, it has to be cost, less depreciation as per the useful life of the asset, less any impairment. Impairment has to be tested only if there are indications of impairment. Otherwise, you don't have to test your assets for impairment on yearly basis. Only if there are indications of impairment, then only you will test that asset for the impairment and follow the criteria given under Ind AS 36, that is a separate standard on the impairment. If you're following the revaluation model, you will use the revalued amount and depreciate that revalued amount over the period of the useful life. Now, for the purpose of intangible assets, you can follow the revaluation model only if there is an active market for that particular intangible asset. If there is no active market for that intangible asset, you cannot follow the revaluation model for that intangible asset. And it is very difficult to identify whether there is an active market for an intangible asset or not and prove there is an active market. Because intangible assets are such assets which you do not, unless these assets are in the nature of software or something, other assets like patents, copyrights, your own customer price list, it is very difficult to identify whether there is an active market for that assets or not. One more thing which is not linked to this standard but is linked to Ind AS 103, that is business combinations. Just to give a slight highlight. Now, under your previous gap, if you were doing a business combination accounting or a merger or amalgamation accounting, you used to capitalize only those assets which were appearing in the books of your transferor into the books of the transferee. I'm a company A, I'm acquiring company B. Whatever assets and liabilities are appearing in the books of company B, only that I can capitalize in my own books. But under Ind AS 38, that is intangible assets, there is additional criteria. Even if a particular asset was not appearing in the books of in the books of that company, in the books of company B, in my example, but that asset is meeting all the criteria of intangible assets, then you can capitalize that assets into your own books in your business combination accounting. Continuing my example, if the company B had not capitalized the customer price list into its own books, because they might not have considered it as a future economic benefits for that price list, but I'm Facebook, I'm acquiring that particular company. For me, that customer price list is the main asset on account of which I'm acquiring that company. I can capitalize that customer price list as a separate asset at the time of business combination accounting, even if that asset was not appearing in the books of the transferor company. So this is linkage of Ind AS 38 and Ind AS 103. What will happen on account of such separate accounting? Your amount of goodwill will be reduced. If the company has a net worth or a net assets of say 100 crores, I have given say 1000 crores for acquiring that company. I have paid additional for what? My the way of measuring that customer price list was say it got a value of 500 crores. Your goodwill amount reduces by that proportion and your asset of customer price list come into your books of accounts. And that is again a mandatory thing. There is no option whether you have to capitalize a customer price list or not. If there is a business combination and there is a particular asset which can be capitalized separately, you have to capitalize that particular asset separately. Okay. Moving ahead to depreciation and amortization on the property, plant and equipment and intangible assets as well as the investment property. Investment property has to be measured at cost that we have discussed previously. Depreciation is similar to what we have discussed previously. it has to be allocated or it has to be apportioned on the useful life of the asset. Component accounting comes into the picture, what we have discussed earlier. So on the basis of the useful life of that component, you will have to depreciate that asset. There is again lives given under the Schedule 2 of the Companies Act. You will have to take a reference of that life given under the Schedule 2, and you will have to amortize that particular asset over that useful life. Now, what is another difference? You have two methods of depreciation: straight line method of depreciation and WDV method of depreciation. Change in the method of depreciation, for example, from say SLM to WDV, under the previous GAAP was classified as a change in accounting policy and had to be given a retrospective impact. But in the current standard, under Ind AS 16, linked with Ind AS 8, this change in estimate of change in depreciation from WDV to SLM or SLM to WDV or whatever is a change in estimate and has to be given impact prospectively. There's a logic to this also. What does the standard say is WDV or SLM is a base of estimate. How do you estimate your asset will be used? If I'm having a plant and machinery, why do I use a WDV method? Because I expect or I estimate that in the initial years it will give me more benefits and in the subsequent years it will give me a lesser benefits. If you're changing your method from WDV to SLM, it is a base of estimate. Now you're estimating that it will give you benefits over a straight line period. So since it is a change in estimate, it should not impact your retrospective financial statements and has to be given impacts only prospectively. No restatement, nothing will happen on account of change in the method of depreciation. You will have to review the method of depreciation and useful life. Now your method of depreciation and the useful life is as good as in both are estimates. Both are at par for you. So you will have to estimate or you will have to revisit your estimates at the end of each reporting date. At least once in a financial year, you will have to revisit whether your estimate of useful life and the estimate of the method of depreciation is appropriate or not. Now, amortization. This was all about how do you depreciate the property, plant and equipment and the investment properties. Now, what about the amortization? Under intangible assets. Previously, under AS 26, you had normal criteria of you should amortize it over the strict period of 10 years, or in case of your amalgamation standard, you used to amortize the goodwill over a period of 5 years. But over here, you have the amortization criteria based on the useful life of that particular asset. And one more important criteria you will have is your intangible asset can have an indefinite useful life. What does that mean? You can classify a particular intangible asset that this asset will give me a benefit over a period of indefinite period. That is why I decide the useful life of the intangible asset as an indefinite useful life. And if a particular asset is defined as an indefinite useful life asset, you do not amortize that asset. So proving this it is having an indefinite useful life is difficult, but it has to be amortized. It will not be amortized in case it has an indefinite useful life. A classic example which falls into this criteria is goodwill on acquisition. For example, you are paying certain additional amount for the purpose of goodwill on acquisition. Under the previous GAAP, you used to amortize this particular goodwill over a period of 5 years. But under Ind AS, you are not allowed to amortize the goodwill. Mandatorily, you don't have to amortize the goodwill. It will stay into your balance sheet for an indefinite period. Only you will measure that goodwill for impairment at every reporting date. So as we previously discussed, property, plant and equipment, investment property has to be tested for impairment only if indications arise. But for the goodwill, you will have to test the goodwill for impairment at every financial year. So that is the difference between the impairment criteria also. So goodwill is not amortized in the Ind AS and it has to be tested for impairment. So goodwill on amalgamations, goodwill on business combinations, goodwill on consolidation, any goodwill should not be amortized into the books of accounts. Now, as we discussed, how do you define the useful life? It is very simple. What is the expected life of the asset? How many life cycles are you expecting? Is the asset of obsolescence in nature? What is the industry applicable for that particular asset? All these criteria you will check to define the useful life of that particular asset. Now, another is, how do you define whether the life of the asset is indefinite or not? If you see that there is no foreseeable limited period over which the benefits are expected, you cannot limit that period. Only in that cases you define the useful life as an indefinite useful life. The important thing is, indefinite useful life does not mean an infinite life. There is a difference. Indefinite is only when you cannot estimate or you cannot foresee over what period the asset would give you the economic benefits. Moving ahead. Now, we saw that there are various differences between the Ind AS and the Indian GAAP. We also saw it how it is different from the older AS10 and the revised AS10. Now, what to do in case of the first time adoption? You are applying the Ind AS first time to your companies. There are listed differences. What to do in that case? Do you have any exemptions as we discussed as per Ind AS 101? Now, there are exemptions for the purpose of property, plant and equipment, intangible assets and investment property. The exemptions are, and these are exemptions, it means that these are optional in nature. If the company wants, it can apply Ind AS 16, 38 and 40 on a retrospective basis. It can change all the values, give the impact as on the date of transition and move ahead to Ind AS. But if the company wants, at the option of the company can use these exemptions. So what is the exemption? You can carry your property, plant and equipment, intangible asset and investment property at a deemed cost. What does this deemed cost mean? Deemed cost means either of these three options. First option is your deemed cost can be fair value of the asset. So fair value means you can fair value as on the date of transition and give the impact of the fair valuation as on the date of transition and carry the assets at fair value. So fair value is different and revaluation model is different. So if you are using the fair value option as on the date of transition, that does not mean you will have to use the revaluation model forever. No, not that way. So for example, if my land, the cost of the land is 10 crores. As on the date of transition, I fair value it, land and building, and fair value it to 50 crores. So the 40 crores gain will be transferred as on the date of transition. And therein after, I can still follow the cost model and depreciate this 50 crores over the tenure or over the useful life of that asset. I don't have to use again revaluation. So once I use this fair value model or fair value option, does not mean that every reporting year I will have to use the revaluation model only. It is not linked. Secondly, an event-based valuation. For example, previously I was thinking to, or I was into the this thing to conduct an IPO. I filed my DRHP. At that point in time, I had conducted the valuation of my properties. So can I use that valuation? So this is an event-based valuation, which can become the deemed cost for the purpose of your property, plant and equipment, intangible assets and investment properties. Or the third option, which is the companies which have used, majority of the companies which have used this option is continuing with the Indian GAAP amounts as it is. So no changes made, only continuing with the whatever amount is appearing in your Indian GAAP financial statements will be continued as it is into your Ind AS financial statements, which will become the deemed cost. So whatever differences were there previously, whatever you would have capitalized, that all is subsumed into this deemed cost exemption. Whatever is your Indian GAAP value becomes your Ind AS value. There is only one exception to this is if you have a decommissioning and restoration obligation, you will have to account for that restoration obligation and then move ahead. If you don't have the decommissioning and restoration obligations, then you move your Indian GAAP value as it is to the Ind AS value. No changes are to be made. So these are the three exemptions which are for the purpose of transiting from Ind AS to from Indian GAAP to the Ind AS. To discuss, to decide how many differences are there between Ind AS and Indian GAAP, we will discuss all the key differences in a brief manner so that you understand why these exemptions are so much relevant. Between Ind AS 16 and the AS 10, One more difference is, the difference which is linked with the borrowing cost standard is, I'll discuss that exemption also. For example, if you have purchased an asset, today I have purchased the asset, but my terms with the creditors are, I will pay you the payment after 2 years. Now these are deferred terms. Nobody gives a credit period of 2 years on a generic basis. You have the deferred credit period for your asset. In that case, for example, if my cost of asset is 100 crores, I have decided the terms with my creditor as I will pay this amount after 2 years. So what to do in that case? Should you capitalize the asset as 100 crores or at a different amount? In that cases, you will have to discount that 100 crores to present value by the 2 years difference. For example, that value comes up to 80 crores and you will capitalize that amount at 80 crores. So your asset or your property, plant and equipment will appear at 80 crores and not at 100 crores because you had a deferred payment terms. You had an extended credit period as compared to a normal credit period. So in that case, you will discount the asset and then capitalize the asset. Second difference, which is linked to the borrowing cost standard is, for example, you would have capitalized the borrowing cost into the cost of your asset. You would have capitalized the interest component because it met the particular criteria of the borrowing cost. Under Ind AS, you will have to capitalize the borrowing cost at an effective rate of interest. What is effective rate? That we will discuss later on in the financial instruments and many other standards. But effective interest cost under the normal rate of interest, which is charged by the bank, and interest cost under the effective rate of interest is different. So your borrowing cost, which would have capitalized in the property, plant and equipment under Indian GAAP, vis-a-vis under Ind AS would come up to be different. So in that cases, this will also be a point of difference. Then there is another difference of Forex. Do you remember under AS 11, there is an option under para 46A, which says that you can capitalize the Forex cost into your cost of the asset if it meets the particular criteria. There might be many companies who would have capitalized the Forex gain or loss into the cost of property, plant and equipment. Under Ind AS, there is no such option given to the company. You might have heard of certain reserve made by the company as foreign currency revaluation reserve. That was when the companies used to capitalize such such Forex differences into their property, plant and equipment. So even that Forex gain or loss is not allowed to be capitalized under Ind AS. So this is another difference. Second and third is what we discussed, change of depreciation. If you would have given a retrospective impact on account of change of depreciation from SLM to WDV, WDV to SLM, that is again a difference. Here it is prospective, there it was retrospective. Administration and general overheads, those you might have capitalized certain admin and general overheads, but under Ind AS it is not allowed. Then is the restoration and dismantling obligation. You might already have a restoration and dismantling obligation. Till date, you did not make any provision. Again, there is a difference. So that is why you have to use, or companies tend to use either of these optional exemptions because it is very difficult to change your property, plant and equipment from the day one of capitalization and bring it to the value as on the date of transition. Further, what is the differences between intangible assets and your previous standard of AS 26? Subsequent measurement under AS 26 and intangible assets, your depreciation criteria are different or amortization criteria are different. Useful life, infinite useful life was never allowed under Ind AS or Indian GAAP. Intangible assets acquired under a business combination, as we discussed, customer price list, fair valuation was never there under the Indian GAAP. Goodwill on acquisition or consolidation, this was always amortized under the Indian GAAP and it is not allowed to be amortized under the Ind AS. So using these exemptions, you can carry your assets under either of this option and continue with the deemed cost exemption. Now, one more key change or one more key resultant effect of this deemed cost exemption is what? What does this deemed cost exemption say is your WDV as on the date of transition becomes the cost of your asset as on the date of transition. So what does this eventually mean? Your WDV, your gross block minus the accumulated depreciation becomes your cost. So in your FA schedule, what you disclose in the financial statements, as on the date of transition, you have the net WDV as your gross block, and your accumulated depreciation as on the date of transition is nil. You have zero accumulated depreciation as on the date of transition. This is the exact interpretation of this word deemed cost. In spite of this, you might see majority of companies have used this deemed cost definition as it is, and they have shown that their WDV or accumulated depreciation as on the date of transition as nil. But there are also various companies which have not used this deemed cost as it is, and still they have shown the WDV as on the opening date as it is. What difference does it make? Every time whenever you sell that asset, you will have to differentiate between what was the accumulated depreciation as on the date of transition and what was the accumulated depreciation after the date of transition. Why? Only that part which was accumulated after the date of transition will be removed from accumulated depreciation, and rest entire part will be removed from your gross block. So forever you will have to maintain your FAR as if what was the WDV as on transition date and what is after the transition date if you are using this deemed cost exemption. So this is a direct implication of this deemed cost exemption where you are using the values as it is under the Indian GAAP. What are the disclosures differences required under these standards? So the disclosure differences were the same, or disclosure requirements are the same under the Indian GAAP and Ind AS. That is, you give a schedule on the property, plant and equipment and intangible assets. But for the investment properties, you have a separate requirement. You have to show the opening value, add additions, less deletions, gross block, and the accumulated depreciation. But you also have to give the fair value of the investment property as on the reporting date. This is a mandatory disclosure. So as on every reporting date, you will have to fair value your investment property as per Ind AS 113. That is a separate standard on the fair value requirements. Fair value that investment property and disclose that fair value in your balance sheet. You will also have to disclose what methods of fair valuation you have used. You will also have to discuss what all costs were incurred for the purpose of this, what all are the direct link costs. For example, you give your property on rent. When you give your property on rent, you also incur certain costs such as valuation of that property, designing an agreement for the purpose of the rental agreement. All these costs you will have to separately disclose what all are the costs linked to this investment property and disclose it under the note of investment property. Under your again under in your first Ind AS financial statements, you also give a separate note of what all optional exemptions you have used. If you are using this Ind AS 101 exemption, if you're using this exemption, then you will have to disclose in your financial statements that you are using the Ind AS 101 exemption of deemed cost, and accordingly the values under the Indian GAAP are disclosed same under Ind AS, and you're carrying forward the same values. So you will also have to disclose this optional exemption taken under your Ind AS 101 note. So these was all about the Ind AS 16, 38 and 40 standard. We have also covered the applicability and introduction to Ind AS. If you have any queries, we can discuss this here and after. So we can open the lines for the queries. Abhishek? You can post your queries in the chat section also. Or you can unmute yourself and give up your queries. So one of the query that we have received is, in what cases can we disclose the deemed cost exemption? Is it for only for a disclosure purposes, or it also has to be accounted in the books of accounts? This is one of the query that we have received. Now, in the deemed cost exemption, the standard says that for the disclosure purposes, that is your FA schedule purposes, you will have to use the net basis. That is, your WDB should be 0 is on the date of the transition, and therein after you can use the cost model, I mean the deemed cost model. So this is not an accounting requirement. Obviously, in your accounting, you can follow you can keep a separation between the gross block, separate the accumulated depreciation between the accumulated depreciation as on the date of transition and after the date of transition, and continue with the accounting as you're normally accounting it. Just for the purpose of FA schedule, this deemed cost difference is there where you will have to show the net value. This was the first question about the deemed cost. Second question is, in case of deferred payments, how do you account for the difference between the deferred payment? What does this mean? In case of deferred payments, earlier the value decided to be paid to the creditor was say 10 crores, but the present value is 8 crores. It has to be discounted in this case at your effective borrowing rate. Previously, what we have discussed is the dismantling and restoration obligation that has to be discounted under the risk-free rate of return, whereas the deferred payments has to be discounted at your effective borrowing rate. So if your effective borrowing rate is say 10%, 11%, whatever is your effective borrowing rate, you discount the value of 10 crores using that effective borrowing rate and capitalize that amount into the cost of property, plant and equipment. Whatever is the difference over the period of 2 years, you will debit that amount onto your finance cost. So 10% of the original amount you will debit it to finance cost, and over the period of 2 years, and that value will reach from 7 crores to 10 crores, and at the end of 2 years you will pay it to the vendor. So accounting entries for this would be, as on the opening date, you will debit property, plant and equipment by 7 crores, which is the present value of your deferred cost. You will credit the vendor by 7 crores, which is a deferred value. The first year you will debit finance cost at 1.5 crores, which is 10% of your the original amount, and credit the vendor at 1.5 crores. Second year you will again debit finance cost by 1.5 crores and credit the vendor by 1.5 crores. So at the end of the second year, the value will reach to 10 crores and you will pay that amount to your vendor. So this is how it moves, but here the discounting rate is different. Please remember, for every particular transaction, the rate of discount is separate for that particular transaction. So Ind AS, that is through Ind AS 109, the discounting rate is effective borrowing rate. And previously what we had discussed is provision for dismantling cost. That was as per Ind AS 37, that is the provision standard. So if it is a provision, you go to Ind AS 37. If it is not a provision, it will fall under the financial instruments and you will discount as per Ind AS 109. So if you have any further questions, please raise. We are waiting for it. I mean, we have opened the lines for the questions. Virag, we can open the lines for the further questions.
Yes, we can open that. Just want to tell you that there is a question desk there on your left hand side. You can open that and I mean read the question and answer them.
Question desk.
You have to enlarge that questions. Question tag.
Just a minute.
Right hand side is their option.
Can you read out, Virag, please? I'm not able to get that option.
Okay.
Are there any questions by any?
Read now. Yeah, I can also. So any resulting adjustment arising due to 31st March 2016 and 17 also to be adjusted in opening balance sheet of 15. There is a one question.
No. I'll just explain.
Okay. Property held for employee. Please repeat.
Property held for?
Employees.
Employees. Okay, fine. Okay, fine. So these are the questions. So going for the
One more
first
question,
question.
deep cost also people required to one more repetition.
Okay, okay, fine. All right. So the effects that has to be given as on the opening balance sheet date is only for the transactions that occurred before the opening balance sheet date. So if your transition date is 1st April 15 and your live year is your comparative year is 16-17 and your live year is 17-18, so in that case all the impacts or all the differences which arose before the trade date of transition, that you have to give as on the opening balance sheet date. Your impact for the comparative year has to be given in that comparative year. So for example, if your impact has arose of told you of total differences, you would have capitalized the forex into your property, plant and equipment. Let's take this example. So in that case, you would have capitalized say 10 crores before the transition date, 1 crore in your comparative year, and this is your live year. So whatever was the difference of 10 crores, which was before the transition date, only that you will give impact as on the opening balance sheet date. So you will remove that amount of capitalization from your property, plant and equipment. You will debit it to your retained earnings, and you will credit that amount by your property, plant and equipment. Your depreciation will also change on account of that. So all the cumulative impact of forex and the depreciation net impact, you will give it to your retained earnings and your property, plant and equipment. So your accounting entry will be retained earnings account debit to property, plant and equipment by the net impact of forex capitalized and the impact of revised depreciation. And for example, your next year is 1 crores, 16-17 is your comparative year. In that year, you debited 1 crore to the cost of PP. That impact you will give it in your comparative year. So your forex expense will be inflated by 1 crore because you had capitalized that in PP. So your accounting entry will be forex account debit to property, plant and equipment. That will be the amount that you had capitalized into the PP, and your depreciation will also change. So your depreciation will reduce. Your accounting entry will be property, plant and equipment to depreciation of that year. That is your comparative year. So your amount that appears in your schedule of other expenses will be the revised amount. And you have the current year. So in the current year, you won't capitalize such cost itself. Now, second question was to repeat these deemed cost exemptions. So in case of deemed cost, now as we discussed, there is a difference between the forex as you would have capitalized under the Indian GAAP, and under Ind AS it is not allowed to be capitalized. So one option you have is go back, restate all your property, plant and equipment. Your each item of PP will change. Okay, bring into the value as if this forex would never have been capitalized. This is the retrospective impact. So सब कुछ ऐसा कर दो जैसे कि forex कभी भी capitalize हुआ ही नहीं था and उस value पर PP ला दो. This is the mandatory thing. This is as if अगर ये 101 नहीं रहता था, कुछ भी आपके पास exemption नहीं रहता था, so you would have brought the PP to that value. But it is very difficult, it is very tedious job. Companies are into existence from years, 100 years, 200 years. How will they go back and change the values from past 20 years, 30 years, restate, change the depreciation? It is a very tedious job. To avoid this, the government or the standard has given an exemption that you have three options. So I'll discuss the most important one first, and then I'll go to the least important ones. I mean the least used ones. So first option is continue with Indian GAAP as it is. So भले ही आपने forex capitalize किया है, उसमें the amount have been capitalized, admin overheads भी है, all are such things are capitalized which are not allowed to be capitalized. In that cases, don't change anything. जैसा Indian GAAP का amount है, bring it as it is under Ind AS, no adjustments required. Adjustments सिर्फ किस चीज की required है? The decommissioning and restoration obligation. So decommissioning and restoration obligation only has to be the impact has to be given. बाकी किसी भी चीज का कुछ भी impact देने की जरूरत नहीं है. So no difference, no accounting change required. Hereinafter, after the transition date, if there is any difference, for example, 1st April 15 is your transition date. आपने forex April 15 के पहले जो भी capitalize किया उसको भूल जाओ. 15-16 में कंपैरेटिव ईयर में आपने जो भी कैपिटलाइज किया है वो आपको रिवर्स करना पड़ेगा, और करंट ईयर में आप कुछ भी कैपिटलाइज नहीं कर सकते. सो इट इज ओनली अबाउट द ट्रांजिशन डेट. Comparative year you will have to restate. Current year में तो आप allowed ही नहीं है, you cannot capitalize itself. The third question was about the building given to the employees. Now, company has a policy of giving the buildings for the purpose of allowing their employees to stay in that building. Now, this is as good as it is for the own use of the building. The company is not giving it for the purpose of rentals. This is as good as an admin activity or an employee welfare activity conducted by the company. So this is still a property, plant and equipment of the company. If this company would have given it on rentals, then it would have met the criteria of investment property, and then it was a separate question. But this is purely for the purpose of employees to stay in that quarters, and that is why it will not be a investment property, it will be a property, plant and equipment. So these were the 3 questions that we discussed. If you have any further questions, we can discuss. Otherwise,
yes,
we can.
One cost.
Yeah, tell me.
Subsequent cost. They are asking for one more repetition. Can you please go with the subsequent cost once again like that?
Okay, fine.
Then obviously we will share this presentation. Tomorrow you will get in your mail. And you cannot ask on audio, you have to type only. One more question, other comprehensive income. Then property held for employee investment property or PPE. Is there any decommission cost rule in amended as 10? Again, one more question.
Okay, fine.
Okay, one by one we will go.
So, okay, fine. We'll discuss everything. Subsequent cost is nothing but the additional expenses what you incur later on, whether it has to be capitalized or it has to be transferred to repairs and maintenance. That is, it has to be expensed out. It is a simple concept. Now, what concept is relevant over here is whether you have applied a component accounting. So, for example, मेरी एक पूरी plant and machinery थी, which was of say 100 crores. उसमें से मैंने एक component, which is the main spare of my machinery, that is of 30 crores, I have capitalized it separately. तो मेरी जो main machinery है 100 crores की, वो 10 साल के ऊपर depreciate होती है, और जो मेरा spare part है, उसकी life सिर्फ 3 साल ही है. For example, my airlines, उसका जो interior रहता है, that has to be changed within 3 years. तो वो जो मेरा कंपोनेंट है वो मैंने अलग से कैपिटलाइज किया है और बचा हुआ कंपोनेंट अलग से कैपिटलाइज किया है. सो व्हेनेवर आई रिप्लेस द स्पेयर पार्ट विद अ न्यू स्पेयर पार्ट, इन दैट केसेस मेरा 30 करोड़ का वैल्यू था जो सेपरेटली कैपिटलाइज था, उसको मैंने डेप्रिशिएट किया 3 साल के ऊपर. अगर मैंने 2 साल के बाद ही वो स्पेयर पार्ट रिप्लेस किया तो मेरी WDV क्या रहेगी? अज्यूम 20 करोड़. 20 करोड़ डेप्रिशिएट हो गया, 10 करोड़ मेरा WDV बच गया. So 10 crores को आप de-recognize करोगे, you will transfer it to P&L and then you will capitalize the cost of the new spare part which is the 30 crores. Assume same value है. तो आप जो 10 crores दिख रहा था बुक्स में, अभी तक WDV था उसका, वो आप de-recognize कर दोगे and you will capitalize the value of the new value of the spare part, that is the 30 crore value. So this is about the subsequent cost. प्लेन वेनिला है जो आपका रिपेयर्स मेंटेनेंस में जाएगा या कैपिटलाइज होगा, ये प्लेन है, ये अभी तक आप करते आ रहे थे, बट द लिंकेज इज विद द कंपोनेंट अकाउंटिंग. देन द सेकंड क्वेश्चन वाज द अदर कॉम्प्रिहेंसिव इनकम. अदर कॉम्प्रिहेंसिव इनकम ये फर्स्ट लेक्चर है, इसमें आपको इतना डिटेल में समझ में नहीं आएगा, बट जस्ट टू गिव अ मोर आइडिया इज इट इज जस्ट लाइक अ स्टेटमेंट under which you will have to give certain disclosures. It is just a thing where you will have to give certain items which have to be disclosed. मतलब क्या है कि एवरी आइटम, हर एक आइटम से P&L को इम्पैक्ट नहीं करना है. देयर आर सर्टेन आइटम्स ड्यू टू व्हिच द प्रॉफिट एंड लॉस इज नॉट टू बी इम्पैक्टेड. You should not affect your profit for such account. You should not affect your EPS also for such accounts. These are not your day-to-day business activities. So such items are listed in the standard. ये सारे आइटम्स आपको P&L से रूट नहीं करने हैं. दिस अकाउंट्स, these items you will directly move into the reserves. आपका अकाउंटिंग एंट्री क्या होगा? रिजर्व टू रिजर्व, एसेट टू रिजर्व ये एंट्री होगा. बट फॉर द डिस्क्लोजर पर्पसेस आप उसको अदर कॉम्प्रिहेंसिव इनकम, स्टेटमेंट ऑफ अदर कॉम्प्रिहेंसिव इनकम में डिस्क्लोज करोगे. जो मैंने एग्जांपल दिया था, इन्वेस्टमेंट्स, आई एम नॉट होल्डिंग इट फॉर ट्रेडिंग, सो व्हाई शुड आई इम्पैक्ट माय P&L फॉर दैट? So in that cases, what accounting entry will I pass is, increase the value of investments, मेरे investments fair value पर ही दिखेंगे, but the gain, you have two options, P&L में gain आना चाहिए या कहाँ जाना चाहिए. So in that cases your gain will not be transferred to P&L because it is not your day-to-day activity of trading into the investments, and your that gain will be transferred directly to the reserve. So आपका accounting entry क्या होगा, investments account debit to fair valuation gain on that investments. This will be your accounting entry. But your this gain, amount of gain, मेरा 10 crore का gain हुआ, this has to be disclosed in the other comprehensive income, routed through other comprehensive income. So आपके other comprehensive income में it is just a statement below the P&L. I'll just show you for an example. कोई भी आप एनुअल रिपोर्ट निकाल लो, इंडेस के एनुअल रिपोर्ट ऑनलाइन, यू विल सी स्टेटमेंट ऑफ प्रॉफिट एंड लॉस, नीचे आएगा स्टेटमेंट ऑफ अदर कॉम्प्रिहेंसिव इनकम, उसमें एक आइटम आता है फेयर वैल्यूएशन गेन ऑन इन्वेस्टमेंट्स, अमाउंट इज 10 crores. It is that you just have to disclose that item in the statement of other comprehensive income. ऐसे उन्होंने बहुत सारे आइटम्स दिए कि ये सारे आइटम्स आपको OCI में है दिखाने हैं, अदर कॉम्प्रिहेंसिव इनकम में दिखाने. So these were the two questions. Anything we left? Employees के अपन ने discuss कर ली. The building given to employees.
A deferred payment, borrowing cost for deferred payment.
Borrowing cost for deferred payments. Okay.
Again same. Repetition
Okay,
on government grant mode for acquisition.
There is a separate standard on the government grant mode, so that is why I didn't discuss it over here on detail. So we'll discuss that in the government grant standard. Okay. I'll tell you about the deferred payment is. Deferred payment is only if you have an extended credit period. This concept was never there under Indian GAAP. So for example, आपको एक asset आपने आज खरीदा है जिसके लिए आपको 2 साल के बाद पेमेंट करना है. तो 2 years is not a, tell me logically, अगर आपको 2 साल के बाद पेमेंट करना है और अगर आप आज के आज एसेट लेके जाओ, will the value of asset be same as a prudent businessman? अगर आप आज के आज एसेट लेके जा रहे हो तो भी 100 करोड़, 2 साल के पैसे दे रहे हो तो भी 100 करोड़. Is it technically or feasibly possible as a prudent person? No. So what does it mean if the person or if the businessman has given me an extended credit period? It would have obviously increased the price of my asset to the extent of the finance charge over it. Is it true? Is it correct? So अगर businessman ने मेरी value बढ़ा के दी है due to the extended credit period it has given me, तो हमने capitalize asset कितने पे करना चाहिए? Should I do it at 100 crores, which is my inflated value, or should I make any adjustment? तो मेक एनी एडजस्टमेंट का मतलब क्या है, जो उसमें फाइनेंस कंपोनेंट था जिसके ऊपर, फाइनेंस कंपोनेंट मतलब क्या, टाइम वैल्यू ऑफ मनी. अगर आप मुझे आज के आज पैसे दे रहे हो तो मैं आपको एसेट 80 करोड़ में देता था, बट सिंस यू आर पेइंग मी आफ्टर 2 years आई एम चार्जिंग यू 100 crores. दिस वुड बी द लॉजिकल प्रूडेंट बिजनेस ट्रांजैक्शन. तो आप एसेट 80 crores पर ही रिकॉग्नाइज करोगे और फिर आप वेंडर को देना तो बाद में 100 crores है, तो asset would appear at 80 crores. Your vendor would be credited at 80 crores on day 1. What will happen subsequently? Subsequently क्या होगा, आप हर साल 10 करोड़ का फाइनेंस कॉस्ट डेबिट करोगे P&L को. So your accounting entry will be finance cost account debit 10 crores to vendor 10 crores. Next year में एंट्री क्या होगा, फाइनेंस कॉस्ट अकाउंट डेबिट 10 crores to vendor 10 crores. इसका मतलब क्या है, जो उसका रियल फॉर्म था ट्रांजैक्शन का कि आपको ये कितने में मिल रहा था एसेट, अगर आपने आज के आज पेमेंट किया था तो वो एसेट कितने में मिलता था, आपको 80 crores में ही मिलता था. व्हाट इज योर फाइनेंशियल रिफ्लेक्टिंग, करेक्ट. सो यू हैव अ करेक्ट पोजीशनिंग ऑफ द ट्रांजैक्शन. सो दिस इज अबाउट द डेफर्ड पेमेंट. और आपको कोई भी वेंडर इमीडिएटली नहीं बताता है कि अगर आप आज का एसेट लेते हो तो आपके लिए ये वैल्यू है. तो इसीलिए व्हाट डू वी डू, ऑन अ लॉजिकल बेसिस हम वो डिस्काउंटिंग करते हैं डेफर्ड पेमेंट की और उसकी प्रेजेंट वैल्यू पर एसेट कैपिटलाइज करते हैं. So this is about the deferred payment and this is logical. So if you'll see in days, it is more about the logics than about the core principles. And then another question is,
yeah, we have covered almost all question. If any question is left out,
yeah, fine. Hello? I guess we have covered everything. Yeah, we have covered everything. I'm just checking over the questions. Okay, fair. I guess we have covered everything. Yeah.
Yes, I think. So guys, this
Fine.
will
So,
is just first session. It's a 5 day series basically. So we will try to cover almost all the Ind AS. So tomorrow's session we have already launched, and we have not launched for the public as of now. We have launched only for the attendees of the today's session. So kindly fill this before 7:30. After that, it will go to a more public, and you may not get the chance to attend for tomorrow's session. And the procedure is, once you make the payment, you have to again uh, require your details to be submitted for the Gotowebinar app, and only you will be able to log in tomorrow. And tomorrow we will start the session exact at 5 to 7 session. Tomorrow we will not wait for 15 more minutes to all the participants to join. So this is for the information of all. Abhishek, would you like to say anything?
No, Virag, thank you.
So it's a ongoing series. We got wonderful feedback. Around 90% attendees have given excellent and very good rating for both the poll what we have launched in between the session. So thank you very much. On behalf of me and Abhishek, will there is a one bad news, and also we can say good news for all of us. Learning session in between, government has announced lockdown period is till 30th April.
For
So
Maharashtra only.
yeah, for
For
Maharashtra at least now, Maharashtra government. So we have more time to learn things and get our skill more powerful. So thank you, Shweta, and also thank you, Jugal. Jugal is our very good friend. For all the support and making this session as a very wonderful knowledge sharing session. Thank you all for
thank you.
participation.
Thank you, thank you.
Thank you.
Thank you, Shweta.
Thank you. Thank you, and bye, guys.
Bye,